Income Tax 2020. Savor's Credit Retirement Savings Contribution Credit. Come in, relax with Income Tax 2020. Savor's Credit Retirement Savings Contribution Credit. When thinking about the income tax equation, we're going to be on the bottom half looking at the credits and payments section, remembering that we can break our income tax formula into two halves, the top half then being a modified income statement, the second half then being the calculation of the tax and then application of the payments and credits to get down to the tax refund or the amount that will be due. We're going to be focusing in down here on the credits. We can compare and contrast credits to deductions, both being good things for taxes, but if you have $1 of credit and $1 of deduction, the $1 of credit will be worth more because you're basically getting the full dollar's amount worth. Whereas if you have a deduction, whether it be an above the line deduction or below the line deduction, you're typically only going to get a benefit related to it in relation to what the tax rate is, as opposed to getting that full dollar worth of benefit as you do if you get that same dollar as a credit down below. That's why it's going to be down here with the payments, because the amount of benefit is basically equivalent to as if you basically made a payment of that dollar. So we're going to be thinking about then the Savor's credit with relation to the form 1040. If we go on to the 1040, this is the second page of the 1040. We can see that the credit is then pulling over here on line 20. And then we have a related schedule. This is coming from Schedule 3, line 7. So if we go then to Schedule 3, we have our credit. This is the Retirement Saving Contribution Credit, which is then coming from Form 8880. Here is Form 8880, or the first half of it, Credit for Qualified Retirement Savings Contributions. And we'll see more of this form in the following presentation when we take a look at practice problems that run different scenarios, actually looking at the forms and the data input into tax software. Here's the second half of the form. Savor's Credit Retirement Savings Contribution Credit. You may be able to take a tax credit for making eligible contributions to your IRA, individual retirement account or arrangement, or employer-sponsored retirement plan, and beginning in 2018, if you're the designated beneficiary, you may be eligible for a credit for contributions to your Achieving a Better Life Experience, or ABLE, ABLE account. You're eligible for the credit if you're age 18 or older, so you got to be older than 18, not claimed as a dependent on another person's return, so you can't be claimed as a dependent by somebody else. And then this one's kind of a strange one, not a student, so you can't be a student. So then you got to ask, well, what does it mean to be a student? You know, how much student stuff do I need to do to be a student that would disqualify me for the credit then? You were a student if during any part of 5 calendar months of the tax year you were enrolled as a full-time student at a school. So we're talking full-time student for 5 calendar months of the year, took a full-time on-farm training course given by a school or state, country, or local government agency. A school includes technical, trade, and mechanical schools. It does not include on-the-job training courses, correspondence schools, or schools offering courses only through the internet. Amount of the credit. So how much is the credit? Well, it's going to be depending on your adjusted gross income reported on Form 1040 series return. The amount of the credit is 50%, 20%, or 10% of. So we're going to have these different percentages that will be based on the adjusted gross income. It's going to be kind of like a type of phase out that we have here. So we have contributions you make to the traditional IRA, to the traditional or Roth IRA. So it could be 50%, 20%, or 10% of the contributions you make to a traditional or a Roth IRA. Elective salary deferral contributions. So the amount, if you didn't put money into an IRA, then put into some other retirement plan, such as one with your work, like a 401k. If it was for an employer in the public sector, typically 403b, which possibly would be the private sector. That would be 403b, might be a government job, with the governmental 457b, and then the SARS-SEP, SARSEP, or SIMPLE plan. And then we have the voluntary after-tax employee contributions made to a qualified retirement plan, including the Federal Thrift Saving Plan, or 403b plan, contributions to a 501c18d plan, or contributions made to an ABLE account, that's an ABLE account, for which you were the designated beneficiary that began in 2018. Then we have rollover contributions do not qualify for the credit. So if you rolled over a contribution, meaning you didn't put it into the account like a new type of account, like a new type of IRA or retirement type of account, but rather you took it from some other account and simply rolled it in. It was already under the umbrella, in other words, of a retirement account, and then just rolled it over instead of putting new money in. Well, that's not going to qualify for the credit. Also, your eligible contributions may be reduced by any recent distributions you received from retirement plan or IRA or from an ABLE account. So the distributions may affect the credit. The maximum contribution amount that may qualify for the credit is $2,000, $4,000 if married filing jointly, making the maximum credit $1,000, $2,000 if married filing jointly. So the maximum credit, $1,000 if basically single, head of household, $2,000 if married filing jointly, and the maximum contribution to get that would be the $2,000 and then $4,000 if married filing joint. Use the chart below to calculate the credit. Obviously, tax software would be helpful for the calculation then of the credit, and we'll take a look at some example problems in the following presentation as we put it into tax software. So an example, however, will be Jill, who works at a retail store, is married and earned $41,000 in 2020. Jill's spouse was unmarried in 2020 and didn't have any earnings. Jill contributed $2,000 to her IRA for 2020. After deducting her IRA contribution, the adjusted gross income shown on her joint return is $39,000. So she had $41,000 of earnings. Then after the adjusted gross income is the $39,000. That's usually the one we use for any kind of phase out kind of things that will be put in place. So Jill may claim a 50% credit, so 50% credit of $1,000 for her 2,000 IRA contribution on her 2020 tax return. So we got the 50% of the amount that was put in this case being that $1,000. So here's a table of some of the relevant information for the Savers credit. We have the credit rate, the married filing jointly, head of household, and all other filers here. So 50% of your contribution, we're going to take 50% of the contribution if we have AGI, married filing joint AGI, not more than $39,000. If we had head of household AGI, not more than $29,250, all others, and that would include single, married filing separately, or qualified widower, $19,500. 20% of your contribution if married filing jointly, the income is $39,001 to $42,500, and then the head of household is $29,251 to $31,875, and all others $19,501 to $21,250. And then we're looking at 10% of your contributions if married filing jointly. We have $42,501 to $65,000. Head of household $31,876 to $48,750. All others $21,251 to $32,500, and then 0% of your contributions if more than $65,000 married filing jointly. Head of household $48,750, and all other filers $32,500.